high interest rates smashing the economy. Will Australians have to sell up their home, as Reserve Bank Governor Michelle Bullock stated last week? Well, that's what Dr. Andrew Wilson and I are going to discuss in today's Property Insider Chat. We're also going to explain how the latest home finance figures suggests that we're probably going to be buying $1 billion worth of property a day over the next little while, so maybe Reserve Bank Governor Michelle Bullock was wrong. If you want to understand what's happening to our property markets, please subscribe to this YouTube channel and click the little bell icon so once a week you can be updated on all the latest information. At a charity lunch last week, Reserve Bank Governor Michelle Bullock was asked several times whether the Reserve Bank's 13 interest rate rises were smashing the economy, as Treasurer Jim Chalmers suggested. That was leading up to last week's release of the GDP numbers. Now, she dodged answering that question specifically, but went on to say that around 5% of owner-occupiers who have got variable rate loans would be in relative strife financially, with their income not keeping up with essential spending, things like mortgage payments. She then went on to say that ultimately some may have to make that difficult decision to sell their homes, noting that lower income borrowers were overrepresented in that group of people who are struggling. Now, this, well, let's call it interesting call, sent the media, government and community into a spin. So how bad is the economy? And are we really going to have a heap of forced sales? That's what I want to ask Australia's leading housing economist and chief economist of my housing market, Dr. Andrew Wilson. Hi, Andrew.
Yeah, good day, Michael. And some very disappointing comments from the Reserve Bank Governor, who certainly is impressed in her short tenure as head of the Reserve Bank. All the aggregated data points to a very strong economy. We have low defaults, and low arrears in terms of mortgage payments. The last things banks want to do is to force people into selling their homes, so they do anything to hang on to their mortgagees. And this is a very long journey until that happens. But the aggregated, this is just head-shaking stuff from the Reserve Bank Governor, that, we have an unemployment rate that's lower than where it was during the mining booms, the great mining booms. Our interest rate is, our official interest rates are about 1% below the US. And our inflation rate, however, is higher than the US, which sort of points to the question, maybe we didn't tighten enough when we should have. Of course, we had a tightening nearly a year ago when inflation started to pick up again. Until recently, inflation had started to look like it was picking up again, of course, as we've discussed, on the back of higher oil prices. And the Reserve Bank Governor has been adamant about saying, well, look, she wasn't going to rule anything in or out, which meant that we still had higher interest rates on the cards, but the better results that we had for the July inflation rate certainly, had the spectre of higher interest rates diminishing. And, even if the US cut, which is looking a little more likely now in September this month, we're still, as I said, our interest rates are still 1% below, in fact, more than 1% below the US rates. We're at 4.35 and they're at 5.5. So even if they do cut, it's not going to have, they're coming from a much higher base, but their inflation rate is at 2.3%, Michael. And our inflation rate, having fallen sharply over July, is still underlying at 3.7%. So, to say that in any way our interest rates are high, of course, in the historical sense and in relation to our significant trading partners, and reflecting how strong our economy is. Look at the retail sales have continued to grow strongly over the past year, up over 2%. As I said, unemployment rate, yes, it's moved upwards over the past year, but that was unsustainable in the low threes, where we had those sort of unemployment rates since the early 70s, which was a completely different Australia. There are certainly at the individual level, people unfortunately get into financial strife, which can mean that at the end of the day, they're forced into selling their major asset. But this is very much at the margin. And as I said, arrears and defaults are at very, very low levels. For that to start to rise, we would have to see a significant shift in our economy. That's what creates arrears and defaults. It's when people start losing their jobs, Michael. I'm not sure what the Reserve Bank Governor is talking about incomes growth, because incomes growth is still at near record levels, 4.2% over the past year. This is, again, the level of income growth we saw during the great mining booms of a decade or more ago. So it just doesn't sort of add up. It's a cheap headline, and of course the tabloids are all over that. And of course the government is desperate to, in the blame game. It's facing an election next year, so it wants to take the heat off its own back in terms of being held accountable for, some problems, perhaps, for the people who aren't traveling that well. But the big picture is this is a very strong economy. Our interest rates are historically and in compared to our major trading partners, comparatively low, but our inflation rate is comparatively high. So the question is, maybe the Reserve Bank hasn't had interest rates as high as they should be, but they'd be breathing a sigh of relief as we see the price of oil now falling under $70 US a barrel, which is putting downward pressure on inflation. Let's hope that it continues, and then we won't have the prospect of interest rates having to rise again from what is, arguably a too low position at the moment, given where our inflation has been recently.
Well, in essence, the Reserve Bank's really only got one instrument, and a blunt instrument, to get inflation under control, and that's obviously interest rates, the cash rate. While the federal government and state governments really haven't been helping the RBA's job, they've sort of been putting the foot on the accelerator, offsetting the Reserve Bank's application of the brakes. But maybe was it just jawboning? In other words, trying to worry people so that they're not going to start spending or borrowing in anticipation of lower interest rates, Andrew?
Yeah, well, it's not working, because we've had the latest housing loan data out, which we'll look at today, which is showing extraordinary growth in home lending. In fact, almost unbelievable growth in home lending over July. So it's a very strong economy. Confidence is high. Arrears and defaults are low. The prospect of that increasing would reflect an unemployment rate, moving well above 5%, in my opinion. And that's something that takes some time to develop, a breakout in arrears and defaults, as banks don't want to see people having to sell their houses. I mean, there's no money in that for them, so they do everything in their power. So it's a very long journey to start to see the arrears and defaults moving upwards. And as we learnt during our great recession of the early 90s, Michael, and the lesson the banks learnt then was that people will do anything to hang on to their houses, literally anything to hang on to their houses. And that's where we saw what were then commercial banks moving into the mortgage sector, the home financing sector. Yes. So, look, it's been disappointing from the Reserve Bank Governor, not surprising from the Treasurer, who has got a political agenda there that he's pursuing. And, as I said, the data will reveal itself, Michael, whether we do see any increase. But it's just cloud cuckoo land, given just how strong the real data is at the moment in every respect. To be talking about, higher levels of defaults is just doesn't make sense. Maybe people just don't listen. They don't listen to the Treasurer. They don't listen to the Reserve Bank Governor. And most of all, they don't listen to the tabloids.
Well, yes, that's all changed too. Well, let's follow on your comment about the home lending, because at the moment there are two opposing storylines circulating in the media about the Australian real estate ownership. One storyline the media loves running is the great Australian dream is dead, and that young Australians can't afford to buy a home. On the other hand, the latest Australian Bureau of Statistics data released, the official figures on finance, suggest the dream's very much alive, Andrew. In fact, it's thriving.
Yeah, we had a very big result for the home lending data from the ABS over July, which was, sort of goes in the opposite direction. But there's no doubt that, there's plenty of incentive for first home buyers to get into the market. It is getting tougher, there's no doubt about that. But the tougher it gets in terms of the numbers game, the more incentive there is for first home buyers. And look, a number of the state governments have come to the party in that, and they're offering these shared equity schemes, which are proving to be quite popular. So first home buyer numbers are on the rise, but investor numbers have just gone through the roof, Michael.
Haven't they?
We saw a big result over July, as I mentioned, up by 5.2%. That's a very, very big rise. There are some questions still, and the ABS have sort of conceded that there's some issues with their data for home lending, coming basically from the source of their home lending from banks and APRA. But at the end of the day, housing markets are performing strongly. We've had a very strong winter in a comparative sense in our auction markets. We'll look at the latest auction results at the end of the podcast today. So it all supports the fact, yes, people are out there lending. And when we look at the breakdown of those figures, we see that over the month, investors were up 12.8%, Michael, over the month. They're coming out of the woodwork, investors getting involved with real estate investment. And why wouldn't they? Higher rents, high vacancy rates, low vacancy rates, and prices are continuing to rise. And first home buyers were up by 6.8% over the month, Michael. These are big numbers. Over the year so far, investor lending has increased by just under 30% over the first 7 months of this year compared to the same period last year. So there's plenty of momentum for continuing for investor lending, and over the full year up by 16%, whereas total owner-occupier lending's up 0.6%, which is well below investors, and first home buyers are up 13.8%, Michael. So, they're still finding a way into the market. So I don't think we can say that the dream of housing, the great Australian dream, is behind us, and there's no surprise when we look at the breakdowns for the data that the strong capitals of Perth and Brisbane are certainly performing very well in terms of lending, and no surprise that investor lending in Queensland, South Australia is skyrocketing, given that those three capitals of those states, Brisbane, Adelaide and Perth, are reporting boom time conditions in terms of growth, and investors are wanting to get in on the action.
Well, Andrew, if you do the sums with the amount of new borrowing last month, it suggests we're buying $1 billion worth of property a day. And sure, it's a bit harder, as you said, but people are still out there in the market. Now, the other thing we regularly look at is home building approvals, because we know there's a shortage of properties to buy, properties to rent. Now, building approvals aren't the be-all and end-all, because they've actually got to be pulled out of the ground, but there were some positive moves there, weren't there?
Yeah, we're really in the midst of this volatile month-to-month measure of home building activity, as mentioned by building approvals, Michael. And that's because we get these big shifts from month to month in apartment approvals. So look, you can get 1,000, 2,000 unit developments, and there's a lot of energy and a lot of incentive, to get big developments of units, up and running. Now, as you said, it doesn't mean that they're actually going to become actual out of the ground properties, and even if they do, it'll take perhaps 3 years for them to be properties to be available to live in. But we did see a big rise, up by 10.4% over July, and that was following a 7.2% fall over June. But that's this sort of month-to-month change in the apartment approval numbers. Apartments were up 32.1%, Michael, over the month, and of course that drove the aggregate up. But houses were, again, just marginally higher, up by 0.6%. New South Wales was the top performer, with some big unit developments there coming out of Sydney, up by 25.2%. We're still overall depressed on the trends, but the trend is now starting to look like it's picking up a little bit, Michael, and that's on the back of higher house building approvals. As usual, Melbourne is the epicenter for approvals for housing, and it's interesting when we look at the breakdown that both Brisbane and Perth are approving more houses now than Sydney, and they're significantly smaller markets, and yet they're clearly outperforming Sydney, which again is just reiterating that undersupply and higher price of houses in that Sydney market, and they're finding it very hard to keep up with demand. And Sydney units only just really marginally above Melbourne units at the moment, Michael. So Melbourne, not only the leader in house approvals, but they're also challenging Sydney as the leader in unit approvals as well. No surprise, again, the big shifts over the month in terms of approvals were in Western Australia, in Perth. Big numbers there, obviously plenty of demand for housing in Perth with high prices, skyrocketing prices, and that's incentivising local developers to provide more supply. We are well down when we look at the big picture. In fact, capital city house building or home building on an annual month-to-month basis is still down by 37.9% since the peak back there in 2016. So that's overall. And when we look at the breakdown, unit developments over that period of time are down by just under 60%, Michael, which is a big drop. We've gone from 110,000 at the peak trend level back in 2016 to just 44,000 now over the past year, and that has just fallen like a stone. So over the past 2 years, so it's good that we're seeing the volatility, I guess, from month to month. Well, not so good, because we want to see every month with higher number of unit approvals, but we know there are big constraints still for development of units. Planning constraints, red tape and green tape are all making it still tough for unit developments. But as I said, plenty of incentive given that collapse in the approval of new units over the past 7 years. And all the states are in the same boat, Michael, or all the capital cities are in the same boat, having recorded steep decline. So it's not just about Sydney or Melbourne, it's all the capitals are suffering from a big decline in building approvals for both houses and units over that journey. And Melbourne's has the best performance for houses. No surprise, because Melbourne does build nearly 50% of houses in Australia coming out of Melbourne, of the capital cities, and they're still down, but down by 20% over the past since their peak in May 2018.
Well, we know the government wants somebody to build 1.2 million dwellings over the next 5 years. These figures suggest we're not heading anywhere near those sort of numbers, doesn't it?
No, we're tracking. If we look at the monthly approvals, Michael, in total, we're on the trend. We're tracking it around about 150,000 approvals, right? Approvals a year at the moment. So that's not going to become actual housing. So that's obviously significantly lower than the 200,000 we need a year to be built, not approved. And as I said, we've got these timeline constraints, because even if now we started to move up significantly, which we're not, in apartment approvals, it would take the best part of 3 years for that to become livable properties. And so we're just miles behind, and there's no prospect, and logically we're actually not even seeing an improvement, although the trend has certainly flattened out, and that's because of house approvals, and Melbourne's doing its job there in a sense. So it's looking a bit better for houses, but apartment living is becoming more popular and more of a preferred option. But as I said before, there's significant constraints to development of apartments, and that's only going to continue. Our undersupply, what's the government going to do next? Shut the gates again?
I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. It'll be interesting because clearly we're not supplying enough for the people that are living here at the moment and all those that are going to come. Well, we're into springtime now, and we like to believe that spring's a great selling season, even though people buy property all year round. It was the first proper spring auction market. How did it go, Andrew?
Well, yes, happy spring, Michael, and we are here, and it is the season for buying and selling, and that's because people are looking towards the end of the year completion of their property journey. So they've discussed that over winter, and that's why we start to see that momentum building through August, which we've reported on, of course. The market has been rising over the past few weekends. We have come into the first weekend in actual spring, officially in spring. But really, the spring selling season started a couple of weekends ago, which we always note every year. But we had some mixed results. Sydney and Melbourne were relatively steady with some lower listings, but the smaller markets showed some sharp declines in clearance rates. We actually had smaller numbers of reported auctions, particularly out of Canberra on the weekend. So we need to take this with a grain of salt to some degree, Michael. But we can still expect to see that rebound continuing. Got a few distractions coming up with the football finals, etc., which will lead us into the first Super Saturday in a fortnight's time of auctions. So we look forward to some big numbers there and to see what actually occurs. So let's have a look at the numbers. Just 792 auctions in Sydney at the weekend. I'll say just, it's still a strong number. But down from that big number the previous weekend where there were 912 auctions. But the Sydney clearance rate, Michael, was actually higher at 71.9%. So Sydney's just kept tracking at that plus 70% mark, basically all the way through winter and now into spring. And that's very much a seller's market. You know, when you're getting more than 7 out of 10 properties selling under the hammer of a weekend, that really does reflect strong competition amongst buyers for property. And that's why we're still seeing higher prices. But the big difference in Sydney, when we look at the regional reports, which of course you publish every Sunday, is we're really seeing the higher end of the market becoming active in Sydney. Strong results in the northern beaches again, strong results in the lower north, and strong results in the inner suburbs as well, the city and eastern suburbs in Sydney. And that, of course, is what we see in spring, Michael. In Melbourne and Sydney, we see a blooming, if I could use that term, of higher priced properties coming into the market. And that, of course, acts in a seasonal sense to push up prices because we're getting a higher proportion of higher priced properties. And that's what we're seeing in Sydney and Melbourne. But Melbourne's still not quite getting those higher clearance rates that we would expect in the prestige markets, with the inner east just struggling a little bit again this weekend, as you'll see if you review the report, the National Auction Report, which has those Melbourne and Sydney breakdowns, regional breakdowns. But I think it's interesting also, Michael, Sydney auctions, even though they were down on the previous weekend, are still tracking higher than a year ago. And look, Michael, the clearance rate is not that much different now to where it was a year ago. So again, just because that was, the market had started to peak from that burst that we had over the first half of last year. And like I said, the clearance rate is not that far away from a year ago, and the listings are higher. Melbourne, similar to the last weekend, 949 auctions. Melbourne also had a higher clearance rate, Michael. So some good results in Melbourne and Sydney. I would suggest some good spring results there for Melbourne and Sydney. The Melbourne clearance rate, similar to Sydney, just a little below the same weekend last year. So again, that was the end of the burst out of Melbourne, the winter and autumn burst last year. And auction numbers, same as Sydney's, well ahead of where they were over the same weekend last year. So these markets are still tracking in Melbourne and Sydney, which are the spring markets, Michael, as I said, because they bring out the prestige market. and there's still quite robust results there and very much spring results. Different results there. Brisbane a little disappointing, down at 40%. Again, we didn't get a lot of reported listings coming out of Brisbane, but well down on the year before, but similar on the previous weekend, but similar clearance rate to the same weekend last year, but a lot more auctions compared to the same weekend last year. Adelaide also fell down. Still a good result there, 76.5%, similar auction numbers, and not that far away from a year ago. So nothing much to read into Adelaide. Still a strong market, but below that 80% result that we've been used to seeing in Adelaide at the peak of their market. Canberra, we only had a handful of results coming through in Canberra. It fell down to 38.2%, Michael. I wouldn't read too much into that. We need more results coming in to have a more reliable clearance rate. So we'll await that data as it comes through over the next few weekends. But as I mentioned, the Sydney trend so far over September tracking higher than August, and you know the data shows us that we've been above our weekend clearance rates for the full month have been above 70%. Since December last year, where the market started to ease following the boom conditions of 2023. Melbourne's actually tracking at its highest point since the beginning of 2023, Melbourne, with these clearance rates. And of course, it's just one weekend, so we'll await to see that continuing. But Melbourne's certainly shown some clear signs of a revival through winter, and it has maintained that sort of mid-60s clearance rate, which is not too bad a result for the Melbourne market. And as I said, it's that prestige market that's been dragging the chain in Melbourne. Brisbane down significantly over the weekend. We need to see the next few weekends to see whether that's just been a reporting issue. Adelaide still tracking above where it was in August and July. And I would expect that market to continue to rise. And as I said, we only had small numbers of reported auctions in Canberra on Saturday, and that pulled the clearance rate down. We need more auctions to get a better picture, the underlying picture of the market. You can get those clearance rates, auction results every Saturday night on my LinkedIn channel, Doc Andrew Wilson at LinkedIn, around about 6:30. And Sundays, Michael produces the full national auction market report, which has the regional breakdowns for Sydney and Melbourne, as mentioned, and the top 10 sales for each of the capital cities. And if you've missed that one, there's a QR code that you can get a link to that latest report. So that's us for this week, Michael. You know, spring's here. Looks like it's very much spring in Melbourne and Sydney, all going to plan, I guess, if you're a seller. And with that, those lending data, that latest lending data from the ABS, it looks like it's all going to plan for buyers too, because they're out there securing loans willy-nilly.
Well, that's what I like to hear, that's a forward indicator. People in general get their finance pre-organised before they go out, which means people are looking to buy in spring. And as I said, $1 billion worth of property a day. We'll be back again next week to discuss the latest auction results, as well as all the other things that are happening in the market. Thanks, Andrew.
Thanks, Michael.